Hello and a warm welcome to Advanced Audit and Assurance, your path to AAA excellence. If you're gearing up for the AAA exam previously recognized as the P7 exam, you're at the right place. In this video, we will walk through the past exam question. Get ready, we are not just studying the past exam question, we are unlocking the secrets to decoding the scenarios, finding numerous points we can make in the exam to gain marks easily, masterfully drafting answers up to the examiner standards, and skyrocketing your chances of success in the AAA exam. Stay tuned for game-changing insights that will transform your approach and elevate your ACCA journey. Let's go ahead. In this video, we will be discussing September 2020 question number 1. Now this is a 50-mark question you need to focus on. So you need to stay confident, you need to stay alert to the requirements, you need to follow the requirements of the question. But since this is question number 1, first we will read this introduction of the first page, then we will shift on to the requirements onwards. So let's read. It is 1st July 20x5. The dates are always important. You need to memorize that. You need to mark the dates as soon as they occur in the paper. You are a manager in the audit department of Pegasus and Company. Okay. So you are the audit manager in the audit department of Pegasus and Company, a firm of chartered certified accountants. Okay, that's fine. You are assigned to the audit of the Crux group. Okay, we are auditing the Crux group in this case, which has a financial year ending 30th September 20x5. So you see, date is important. Today is 1st July 20x5 and the year end is 30th September 20x5. This means that the year end has not occurred yet for the Crux group. The Crux group year end is 30th September 20x5 and we are today it's 1st July 20x5, so it's going to appear soon. We don't have the year end figures for the current year. Okay, and is a listed entity. Okay, it's a listed entity, you need to mark this as well. Pegasus and Company was appointed auditor to the group in January 20x5. Okay, we were appointed as the auditors in the current year. Dates are really important. Just look at the connection. Today it's 1st July 20x5. The group, Crux group, year end is on 30th September 20x5 and it is a listed company. We were appointed as the auditors of the Crux group on January 20x5, right? So we did not audit the previous year figures, or we were not auditors the last year. Okay, so you're able to follow what I'm trying to tell you. The group operates in the travel industry, offering a selection of worldwide itineraries and has a fleet of 20 cruise ships. Okay. The group operates in the travel industry. It offers a selection of worldwide itineraries and has a fleet of 20 cruise ships. Okay, perfect. The group operates 3 brands which provide different types of cruise experience. Okay. So the group has fleets, 20 ships and its fleets. The group has 3 brands, okay, with different types of cruise experience. Okay, that's fine. You are provided with the following exhibits. Alright, an email which you have received from Norma Star, the group audit engagement partner. Okay, that's the exhibit number 1 which we have. That is the email from the audit engagement partner. The second exhibit is background information about the group and other matters relevant to audit planning. Okay, because it's the first year audit, obviously audit planning is a major thing to focus on. Then exhibit 3, selected financial information extracted from the group management accounts. Okay, see exhibit 3, selected financial information. We will be making use of the financial information in our answer always. Extracted from the group management accounts. Okay, this is not from the final account, it's from the group management accounts. That is the accounts being maintained with the group at the current time or at the current position. Alright, then extract number 4, extracts from the meeting notes taken at a recent audit team meeting in relation to group planning. Okay, so it's the meeting notes which we have in the extract number 4. Required. Over here, required says respond to the instructions in the email from the audit engagement partner, 46 marks. Note, the split of the mark allocation is shown in the partner's email, exhibit number 1. Professional marks will be awarded for the preparation and for the presentation and logical flow of the briefing notes and the clarity of the explanations provided, 4 marks. But mind it, this is September 2020 question that we are reading, and this carries 4 marks, 4 professional marks in question number 1 only. But currently ACCA has changed its policies, and ACCA has made 20 total marks for the professional marks in its paper out of 100, and those are split 10 marks for question number 1, 5 marks for question number 2, and 5 marks for question number 3. So you need to know, you need to follow that. We need to follow and focus on our professional marks, on gaining full professional marks in the 3 of the questions, right? Because these are easy marks, we can gain 20 of these marks easily. So we need to focus on getting the maximum marks available from the question, professional marks in the exam. Now let's move on to exhibit number 1, where the requirements are stated. See, this is exhibit number 1, email from the audit engagement partner to audit manager. From Norma Star, the audit engagement partner, subject audit planning for the Crux group, date 1st July 2025. This is today's date, right? Now, hello. I have provided you with some information which you should use to help you with the planning, the audit of our new client, the Crux group, for the financial year ending 30th September 2025. Alright, the audit engagement partner has emailed us, the audit manager, some information relating to the Crux group which will help us plan the audit according to the information provided. Alright. I require you to prepare briefing notes for my own use. Briefing notes are always a part of question number 1. You have to write a briefing note in question number 1. That is, it should have a to, it should have a from, it should have a subject, it should have a date. Then it should be followed by an introductory paragraph, which is nothing but a concise re-mentioning of the requirements of question number 1, part A, part B, part C, and part D. That's it. It is a brief you can say a summary of these requirements A, B, C, D, introductory paragraph, always. Then we move on with the part A, where we explain the part A answer. Then we move on to the part B, C, D, follow in a logical manner, in a flow, and then at the end we give a conclusion to the examiner for the question number 1. Always you need to write a briefing note in this format, always. Now see, let's move on with the part A requirement. Using the information in all exhibits, that is exhibit 1, 2, 3 and 4, out of which exhibit 1 is only the requirement of the question. It is always supposed to be the requirements of the question, nothing else. So it's the exhibit 2, 3 and 4 which we need to focus on. Using the information in all exhibits, that is exhibit 2, 3 and 4, evaluate the audit risks to be considered in planning the group audit. Alright, see, 26 marks. 26 marks are easy over here. You need to have the ability, you need to be skeptical, you need to be able to identify audit risks in the case given to you in the exam, so that you are able to elaborate your answer and you are able to define materiality where appropriate, so that each place you define materiality figures, you utilize materiality figures, you gain 1 mark for materiality, you gain 1 mark for the explanation, and you gain 1 mark for the understated risk. That is that understatement or overstatement of the risk due to the materiality or due to the audit risk available. So these 26 marks are always easy to gain. Audit risk is always an easy part of the question paper, but you need to practice, you need to practice and become perfect in identifying points in picking points from the case, in elaborating your points, and in utilizing the information provided. You need to focus on this thing. You need to practice on this thing so that you're able to perform well when you're sitting in the exam hall, or when you're sitting in your exam paper. You need to be able to identify points. Or AAA is nothing but just identification of points in the case given. You have to be able to identify points. You have to elaborate those points, and then it's all. That's it, nothing else. And obviously it requires you to have some background knowledge as well, but you need to focus. You need to identify points. That's it. So audit risk is always an easy part of the question paper, as I assume. But don't worry, I will make a good practice, a good number of questions for the audit risk as well, which will cover audit risk, and you will become an expert for audit risk and reporting. That's it, no issues. So just be focused. Let's follow. Using the information in all exhibits, evaluate the audit risk to be considered in planning the group audit. Okay. Note, this is always important. You need to see what the note says. You are not required to consider audit risk relating to foreign exchange transactions. Okay, you're not required. If it says you're not required to do something, you should better do not do that thing, because the examiner will not reward you marks for the thing examiner says you are not required to do this. So over here the examiner says you are not required to consider audit risk relating to the foreign exchange transactions and balances, as this will be planned separately. So the foreign exchange transactions and balances is audit risk for that is not required. It will not gain any marks. You will just waste your time. You will waste your paper time for if you are working on this portion of the exam in the question paper. So focus on this. Wherever it says you are not required to do this, never do that. If it says you are required to do this, then always do that, because that carries marks. Alright, so we have read the part A requirement up till now, and we better start reading the question paper, the case given, so that we are able to identify points, we are able to pick points. Then we will shift on to the drafting process after once we have completed the points and we have covered up the case given. Now see, we are coming to the exhibit number 2. The background information. It says group operations. Okay. The group operates cruises under 3 brands. We were told this in the introductory paragraph, which offer passengers a variety of cruise itineraries with a wide choice of destinations. Okay, so we are told that the group operates 3 brands of cruise, out of which offer a variety of cruise itineraries with a wide choice of destinations. So the 3 brands, the 3 cruise kinds, are all going in different directions or in the different regions for destinations. Okay, cruises typically last for 2 weeks. Okay, usually last for 2 weeks, though some last for up to 6 weeks. Alright, so it's the cruises period of journey varies from 2 weeks to 6 weeks. The brands are internally generated and therefore are not recognized as intangible assets within the group financial statements. This is perfect. It should not be recognized as an intangible asset because it's internally recognized. Okay. Information about the 3 brands operated by the group is as follows. Okay. The Sunseeker Cruises, the first brand. Explorer Cruises, the second brand. Pioneer Cruises, the third brand. Sunseeker Cruises, cruises which visit beach destinations in the Caribbean, Europe and North America. Okay, so the destinations of the Sunseeker Cruises is Caribbean, Europe and North America beach destinations. Explorer Cruises, cruises which focus on visiting cities and landmarks around the world. Okay, these cruises focus on visiting cities and landmarks around the world. Okay. Third one, pioneer cruises. Cruises which take in areas of natural beauty including the Antarctic and the Alaska. Okay, so let's move on. This was just a general information which we got from the case. Nothing to do on this one yet. But we will be utilizing or we will be making use of this information 2 weeks and 6 weeks in our paper ahead. So stay focused. Business developments in the year Sunseeker. Business developments in the year Sunseeker cruises. In this financial year, the group will spend $75 million. We are given a figure. We will make use of it in materiality on upgrading and maintenance of the Sunseeker cruise ships. All right. These luxury ships have to adhere to a very high standard, so the group regularly incurs high expenditure on their maintenance. Okay. As well as refurbishments, several ships have been enhanced by the installation of new entertainment facilities, including cinemas and gyms. Equipment in the gyms will need to be replaced on average every 3 years. Alright, see. I hope you are able to follow what the examiner, what the question tells you. In this financial year, the group will spend, it's not spent yet, the group intends to spend over here $75 million. That is the current financial year 20x5, 30th September 20x5, $75 million on upgrading and maintenance of the Sunseeker cruise ships. That is only the Sunseeker cruise ships upgradation and maintenance. Okay. These luxury ships have to adhere to a very high standard. Okay, so the group regularly incurs high expenditure on their maintenance. So they form a high expenditure on maintenance for this group, for this cruise line, Sunseeker cruise, because they have to adhere to a very high standard. Okay, as well as refurbishment. Okay, several ships have been enhanced by the installation of new entertainment facilities, including cinemas and gyms. So you see that most of them or several ships of this Sunseeker cruises have been enhanced by the installation of new facilities, which include cinemas and gyms. Oh, all right. Equipments in the gym will need to be replaced on average every 3 years. You are seeing this point. This is important. Equipments in the gyms will need to be replaced on average 3 years. Alright, because of obsolescence of the equipment, because of wear and tear of the equipment, they need to be replaced every 3 years. Alright, so now the next one is Explorer cruises. The Explorer cruise ships, while still luxurious, are the oldest ships in the fleet. And the group is gradually replacing these with the new ships. Okay. During this financial year, two new ships with a total cost of $110 million will come into use. Again, see, we are provided with a figure. We will make use of this figure in calculating our materiality figures. The first thing first. The ships took 3 years to build. Okay, it was built during 3 years period and were constructed by Vela Shipbuilders Company, a company which is not owned by the group. Okay, it was built. These ships took 3 years to build at a total cost of $110 million by the company Vela Shipbuilders. Okay, which is not a group company. Okay, now let's read further. However, the chairman of the group, Max, is also the chairman of Vela Shipbuilders Company. Okay, so it's the key personnel, chairman of the group is also the chairman of Vela Shipbuilders. So it is a key management personnel who is the chairman of both the group, the Crux group and the Vela Shipbuilders, who is providing us with the ships, two ships which we have ordered for $110 million, which took a period of 3 years to build. So the key management personnel needs to be disclosed in the financial statement. I hope you are able to recall the relevant IAS for this one, the relevant standard. that the key management personnel should be disclosed if he is acting for two companies at the same time. And his son is the company's chief executive officer. Okay, so his son, that is the key management personnel, that is the chairman of the group and the chairman of the Bella Shipbuilders. His son is also the key company's chief executive officer. Okay. The purchase of the ships were financed through $110 million loan with a fixed interest rate of 6% per annum. So, don't you recall something? The total cost was $110 million to build two ships, which took a period of 3 years. That is, it took a major period or a substantial period, 3 years, right? At a total cost of $110 million. And this $110 million were financed through a loan with a fixed interest rate of 6% per annum. Doesn't this recall something like borrowing cost to you? What I would like to, bring to your notice is that 110 million were used for the total cost of to build these ships, and 110 million loan was obtained or secured for this transaction. So 110 million, the borrowing cost would have been capitalized in this case because it's matching amounts. Alright, now let's read further. A further 3 ships are currently under construction by Vela Shipbuilders. The group has taken out a loan of $180 million with 6.5% fixed interest rate to finance this capital expenditure. So again, borrowing cost comes in. Alright. Pioneer Cruises, the third one, the third category of cruises or the brands. These cruises are for more adventurous travelers and are growing in popularity. These are becoming more popular, This means more travelers, more sales. In order to visit certain destinations on these specialist cruises, the group has to acquire operating licenses from the local governments. The cost of license acquisition is capitalized as an intangible asset. Alright, so this is perfect. This is right. The treatment is right. Alright, I hope you agree with this. Because see, the cruises are more adventurous. Travelers are growing in popularity. In order to visit certain destinations of this specialist cruise, the group has to acquire operating licenses. Alright, from the local governments. The cost of license acquisition is capitalized as an intangible asset. But since we are capitalizing the cost of this intangible asset, and this operating license would be having a certain period of expiry, a certain period of period under which we can utilize or we can send our cruise on these tours or on these trips, so on these locations. So this is subject to amortization on a yearly basis. The treatment, I'm just telling you the accounting treatment for the operating licenses capitalized as an intangible asset. Now let's come downwards, and this is exhibit 3 which we are going to read now. This is selected financial information. Alright. This column says projected to 30th September 20x5. This is projected, not actual. Alright. And this is actual till 30th September 20x4, which was audited by some other auditor because we have not audited these figures. But we are not provided any information about this being audited by another auditor in the question. Alright. Now group revenue. Note 1 describes this further or in detail or in depth. The projected revenue for this current year is 764 million. Whereas the actual revenue was 670 million last year. Okay, this is group revenue, remember, and we have 3 brands of cruises. The first one was provided to us as Sunseeker Cruise. The second was Explorer Cruises. The third was Pioneer Cruises. Out of which the Pioneer Cruises is growing in popularity, so more visitors, more travelers, and maybe this increase in revenue is due to the Pioneer cruises. But we will move on to note number 1. Revenue includes passenger ticket sales, which account for approximately 85% of revenue. Passenger ticket sales. Then what is the next 15%? Let's see. When customers book a cruise, they are required to pay a refundable 20% deposit, which is initially recognized as deferred revenue. Alright, the treatment is correct. The balance of 80% is paid at least 6 weeks before the cruise commences, and at that point it is also recognized as deferred revenue. Alright, this treatment is also correct. The full amount of the ticket price is transferred to revenue when the cruise starts, irrespective of the duration of the cruise. Now this is something we need to focus on. The treatment of revenue is correct in this case, that when the customer books a cruise, he has to pay a 20% deposit, refundable deposit, and it is treated as a deferred revenue. That is correct. The balance 80% is received from the customer 6 weeks before the cruise commences, and that is also recognized as deferred revenue. That is also correct, absolutely correct. But the full amount of the ticket price is transferred to revenue when the cruise starts, irrespective of the duration of the cruise. What do you think? Is this why I have highlighted this sentence? Is it everything correct, or it's me who is at mistake and I have marked this sentence? Think. I want you to brainstorm yourself. I want you to think. Think of why I have done this. Am I wrong and you are correct, or you are correct? Tell me. I hope you have thought enough, or you have made up your mind why it has been highlighted. Now see, let's read again. The full amount of the ticket price is transferred to revenue when the cruise starts, irrespective of the duration of the cruise. So see, when we are deferring the revenue, the initial revenue 20%, the later balance 80% received, we are deferring that revenue until the commencement of the cruise, right? So that treatment is correct. But why we are transferring this whole amount of ticket price, that is the revenue, as soon as the cruise starts, irrespective of the duration of the cruise? This should also be deferred. There is a cut-off issue which comes in, right? If the cruise is for 2 weeks, this amount will be recognized in 2 weeks time on a daily basis. If the cruise is for 6 weeks, the revenue will be deferred until 6 weeks end, and this amount will be transferred to revenue on a daily basis or on a weekly basis as per the accounting treatment of the company, as the Crux group wants, right? So this treatment is not in line with the accounting standard, that you are transferring the whole amount of revenue as soon as the cruise starts, irrespective of the duration. This needs to be deferred too. I hope you have followed what I am trying to explain you. Then the next point, the remaining 15% of the revenue, that is 85% was from the ticket sales. Now the remaining 15% of the revenue is derived from on-board sales of food, drinks, entertainment and other items to passengers. Alright. So the ticket sale comprises of 85% of revenue. The on-board sales of food, drink and entertainment comprises of 15% of the revenue. You are able to follow? Management monitor this revenue stream closely as it achieves a high gross profit. This is alright, and this is should be because food, drink, and entertainment items are always on a high margin, high gross profit margin, right? And staff are encouraged to maximize these sales to customers, certainly, because they consist of high gross profit margin for the group. Obviously, they would emphasize their staff or encourage their staffs to make more sales of these items, onboard sales items, so that more revenue means more profit to the group, right? Revenue is presented on a segmental basis in the notes to the following statement, to the financial statements, with segments based on the three brands of the group. Alright. The revenue is presented on a segmental basis in the notes to the financial statements, with segments based on the three brands of the group. Okay, so we have got segmented revenue available to us for reference. Sunseeker Cruises. The projected revenue is 320 million, and the actual last year was 288 million. Alright. We have been provided with the comparable figures, and we will be utilizing this figure because it's provided to us in the exam to gain marks, to gain easy marks. Explorer Cruises. 180 million was the projected revenue from this stream, and previous year actual revenue was $190 million. There is a decrease in this case. You see, the first Sunseeker Cruises was an increase, projected revenue was an increase, but in this case the Explorer Cruises is expecting a decrease in revenue. The third one, Pioneer Cruises, 264 million projected revenue, and the actual revenue was 192 million last year. So don't you think this is too much for the Pioneer Cruise? Increase in revenue is too much. But remember, we were provided a sentence above that there is a growing popularity of travelers coming on Pioneer Cruises. So this means that obviously when the when the cruise is becoming popular, it would have increased profits, right? So this is fine. Increased revenue, that is fine. And in the end, we have got a total for both the revenue figures. Now comes the note number 2. But first we need to go up and have a look at what the point number 2 says. First, let's complete this. Group revenue, operating profit for the group projected and the actual last year, profit before tax of the group 81 million projected and 65 million last year. The total assets of the group 1800 million and 1780 million last year, including in total assets. Now, intangible assets, operating licenses. Note number 2. Right? These total assets comprise of intangible assets, that is operating licenses, and the projected is 56 million, whereas the actual last year was 57 million dollars. So this year there is a decrease being followed in the operating licenses, which means that why it is decreasing. First, you need to think of this point too. The first thing is that the group has not obtained any new operating license. So obviously when the group has not obtained a new operating license, there would not be an increase in operating licenses figure. Second, why it is decreasing? Because of amortization. As I mentioned earlier, that if the group is having an operating license as an intangible asset, there would be a year-on-year amortization for this one, right? You're able to follow what I'm telling you. Alright, so let's read the note number 2 provided to us. Operating licenses are required for the Pioneer cruise ships to visit certain destinations. Alright, so it's the Pioneer cruise ships that is only using the operating licenses. Alright. Then licenses are amortized over the specific period to which each license relates. That's perfect. As I mentioned earlier, that the license should be amortized over a specific period or over the period of their expiry. So they are doing the same treatment, that licenses are amortized over the specific period to which each license relates. So obviously each license would be having a different expiry date. Each license would be having a different validation date, so they should be amortized accordingly, not on a specific or on a single basis. All should be treated individually. That is perfect. So their treatment is right. Now let's move on. Property, plant and equipment. That is a part of this total assets because it says included in total assets. Property, plant and equipment. Note number 3. The projected is 1520 million and the last year it was 1510 million. The actual results 10 million increase in property, plant and equipment. Now let's move on to note number 3. Property, plant and equipment. Ships in use, that is 2041 million and the actual was 2010 million last year. Ships under construction 83 million this year, 62 million last year. So the ships in construction has increased because the last year there were 2 ships being constructed, this year there are 3 ships being constructed. Other property, plant and equipment 180 million this year and 173 million last year. Okay, so this becomes a grand total of 2304 million and this becomes a grand total of 2245 million. Accumulated depreciation is being deducted in this case. Okay, accumulated depreciation. This year it's $784 million and the last year was $735 million. There has been an increase in the accumulated depreciation on a yearly basis, and that is right because each asset would have been amortized over from the last year to this year or depreciated from the last year to this year, and the accumulated depreciation figure is supposed to increase. That is perfect. That is in line with the accounting treatment. So then the accumulated depreciation has increased and then we get a carrying amount of 1520 and 1510 for the previous year and for the current year. Now we are moving on to extract number 4, exhibit number 4, the extract from the audit team meeting notes provided to us by the audit engagement partner. Now let's read. A meeting took place yesterday in which the audit engagement partner discussed several issues. Alright, he has discussed several issues in the meeting with the management. The first issue he is highlighting is recent development affecting Pioneer Cruises. Recent development affecting Pioneer Cruises. Okay, let's have a look. Last week, the governments of several countries, which form a major part of the Pioneer Cruise itineraries, withdrew their operating licenses with immediate effect. Oh man, oh man, oh man. You see what has happened? The operating licenses were part of the Pioneer Cruises only, and the government of several countries have, with the immediate effect, withdrawn their operating licenses, which were being a major part of Pioneer Cruises itineraries. Right? So this is something we need to focus on. Let's read ahead. The governments have stated that this is likely to be a temporary measure being put in place to limit the number of tourists visiting areas of natural beauty, but they will not confirm when the group can resume operations in these countries. Alright, now let's recall what we just studied earlier. The group was having operating licenses specifically acquired for the Pioneer Cruise to visit places worldwide, right? And the Pioneer Cruise was becoming popular day by day just because of the places they were being visited by them, right? The natural beauty places they were visiting. The government of those countries have withdrawn their licenses with immediate effect. There is no time period has been provided for cancellation with immediate effect. And the governments have stated that this is supposed to be a temporary measure, but They are not sure until when. It could be 1 year, 2 years, 6 months, 1 month, 2 months, 3 months, anything. They are not sure in this case about the length of time, about the period of time. So something alarming. I hope you have followed what I'm trying to, uh, you know, what I'm trying to bring to your notice, or no? See, the operating licenses were part of the group, the intangible assets of the group. They were recognized in the financial statements. They were being amortized according to the date of expiry for each individual license. And now some countries have given an immediate, withdrawal of the license, or have withdrawn their operating licenses immediately. So don't you think those operating licenses would be amortized? Their carrying value should be, amortized. Obviously, they should be amortized. Maybe some of the licenses don't have any more have value at all, and some would have been amortized to significantly. Don't you think this thing or these points? All right. So it's the amortization effect which is supposed to come in place over here. We'll make points with amortization in this case. Then the second point, security attack, cyber security attack. Okay, what is this now? Last month, the group suffered a cyber security attack in which the personal information of 1400 customers, including their credit card details, were stolen. Cyber security attack at the group and 1400 customers' details were stolen, including the credit card details. Isn't that something alarming? According to a representative of the group audit committee, the group's internal audit team had not properly assessed the risks relating to the cyber security, which is a requirement of recently introduced data protection legislation in the jurisdiction in which the group operates. So they have not complied with the data protection legislation okay, right? They have not complied with this properly, due to which there was a cyber attack on the group. The issue which led to the cyber security attack has now been resolved. Okay, the issue why this occurred has been resolved, but the question is silent about this, about a few things which we can make from this one. Let's brainstorm yourself first. Cyber security attack. I'm reading this again. You should brainstorm yourself of the points which we can draft or which we can make from this point. Initially, if you are a beginner or you are attempting for the first time, maybe you won't be able to find any point for this one, but we will draft points for this one too, and you need to brainstorm yourself, you need to practice. So let me read this paragraph again for you and let us highlight what we can do in this case. Let's read. Stay focused, stay aligned. Cyber security attack. Last month, the group suffered a cyber security attack in which the personal information of 1400 customers, including their credit card details, were stolen. Okay, it's the 1400 customers whose information got stolen. According to the representative of the group audit committee, the group's internal audit team had not properly assessed the risk relating to cyber security, which is a requirement of recently introduced data protection legislation in the jurisdiction in which the group operates. The issue which led to the cybersecurity attack has now been resolved. Alright, see now, I hope you have brainstormed yourself and you have come up with points for this cybersecurity attack. Now, what I will do is, I will share my points with you, or my knowledge with you of what points we can come up with. You have to check yourself that were you able to think the same points as I am doing so. If no, you should focus on working on your brainstorming procedure. You should process yourself. Now see, the first point, sentence. Last month, the group suffered a cybersecurity attack in which the personal information of 1400 customers, it's not one, two customers, it's 1400 customers' personal information, including their credit card details, was stolen. So don't you think that the group would be suffering some penalties, some damages, some fines for such an attack where the personal information of customers was stolen by the cybersecurity attack? Yes. Obviously, this is certain that once the information of your customers, that is the private property of your company, given to you by the customers by trusting your company, that is stolen in your from your records, from your company's records. Don't you think there would be some fines or penalties for that on the company by the laws and regulations applying to your in your jurisdiction? Were you able to think of this point? Now, the second sentence. According to a representative of the group audit committee, the group's internal audit team had not properly assessed the risk relating to cyber security. Group's internal audit team had not properly assessed the risk relating to cyber security, which is a requirement of recently introduced data protection legislation in the jurisdiction in which the group operates. So the internal controls of the company were weak because the group internal audit team did not focus or did not assess the risk relating to the cyber security attack. You able to follow? Were you able to make a point related to group internal controls? Well, if not, no issues. I am again repeatedly saying brainstorm yourself. Think of what points you can make. Each sentence in the question paper has some significance, has some point you can make. It's out of the whole question paper per sentences, 85 to 90% of the sentences of the paper of the scenario consist of a point. It's randomly 5 to 10% or 15% sentences that do not allow us to make any point. Right. Now, since it was a cyber security attack on the group information, on the personal information of 1400 customers, so and the internal controls were weak, it is possible, it is for surely possible that the cyber security attack could have, misinterpreted the data, would have manipulated the data of the company. It could have, made some changes to the data of the company, which would have resulted in inaccurate figures for the revenue, which could have led to reduced costs for the company. There could have been anything. We are not sure what the cyber security attack did, but it could be anything. But since it's based on the personal information of customers, that is their details, so it's not the profit which we will be highlighting in this point, it's the revenue, because the customers generate revenue. So we will draft our answer. When we start drafting, we will draft our answer based on the revenue over here, because it's the revenue which could have been changed, which information could have been manipulated by the cyber security attack. I hope you were able to make these 3 points which we just thought of in this one. I know it's difficult. I know this one was a bit tricky to identify points, but you need to become skeptical. You need to think of points and you need to identify points. Alright, so now let's move on further with social and environmental information. The Group Audit Committee has inquired whether Pegasus and company can provide an additional service to advise management on how to measure certain social and environmental information, which is to be published in the group's website and is required by new regulations in the industry. Let's leave this paragraph and the next one, audit data analytics, because this is something to do with the next parts in the question. Let me show you the requirement of the question. See, evaluate the matters to be considered in deciding whether Pegasus and company should accept the engagement to provide advice on the group's social and environmental information. So that paragraph relates to this part C requirement. And respond to my request regarding the use of audit data analytics to enhance audit efficiency, effectiveness, and quality in the group audit. 5 marks. This also relates to that paragraph which was following the social and environmental information of data analytics to be used. So we will jump to those paragraphs when we are doing part C and part D of this question. Right, so we have covered up so many points for the audit risk of the to be considered in planning the group audit. I hope you are able to memorize or you are able to recall the points we just made. But let us shift to drafting the answer, and once we have started drafting the answer, you will get a good insight of how to identify points, how to draft points for the audit risk part of the question. I want you to think, I want you to brainstorm yourself, and I want you to pass this paper easily without any hurdles or without any issues. I want you to practice, practice, and practice, as practice makes a man perfect. So I want you to practice enough. I want you to practice, practice, and practice. So let's shift to drafting. And for drafting, I would suggest you to always read this exhibit number 1, email from the audit engagement partner. We will be utilizing this information in our answer on the briefing notes, where 2 becomes the from becomes the 2 and the 2 becomes the from in the audit briefing note which we will write, because we are the audit manager and from will be the audit manager, and we are addressing to the audit engagement partner in the briefing note. So this becomes the 2 in the briefing note which we write. Subjects remain the same, date remains the same, it's your choice. You write the date or you just mention date and then you leave it blank. So the examiner knows that you know the format of the briefing note. That's it. Then followed by the introductory paragraph which will summarize the requirement A, B, C, D, and then we shift on with the answer to the part A in the exam. So let's move on to our drafting process. Now we are drafting question number 1, part A, the audit risk portion of this question. So let us first draw a format. So let's see to, from, subject, and the date, right? Right, I hope it's visible now. So let's follow. 2 is the Norma star. We are replying to Norma star audit engagement partner. Right? The from becomes us, the audit manager. Remember, you're not supposed to write your name in this case in the briefing note, because that is subject to it's going to be strict action against you by the examiner. So never mention your name. It's just the audit manager. You just have to follow this in the email you have received. Just have to follow this and use the same wordings. Subject: audit planning for the Crux group. Audit planning for the Crux group, right? And date, it's your option it's totally up to you. If you want to write, you can write, otherwise leave it blank. Since we are given in the question 1st July 20x5, we will mention the same date over here, right? Now the format of the briefing note. First we have to give an introductory paragraph, and as I told you, introduction, right? We are labeling it so that it becomes easier for the examiner to identify that you know the format of the briefing note. And as I mentioned earlier, we will be utilizing this requirements of A, B, C and D in our introductory paragraph and summarizing that. That's it, nothing else. So let's see. The part A tells us to evaluate the auditors to be considered in planning the group audit. Part B tells us to design the principal audit procedures to be performed on the segmental information relating to the group revenue. Part C tells us evaluate the matters to be considered in deciding whether Pegasus and company should accept the engagement to provide advice on the group's social and environmental information. And part D tells us respond to my request regarding the use of audit data analytics to enhance audit efficiency, effectiveness and quality in the group audit. Okay, so we have to summarize these points in our introduction paragraph. So let's begin. The briefing notes, because the audit engagement partner wanted us to write down briefing notes to assist him in the planning of the audit, right? So the briefing notes are prepared. We are replying to him, right? Just that, are prepared to assist with planning the audit of the Crux group, right? A sentence just replying for the audit engagement partner. But we need to, let's see, look, the briefing notes are prepared to assist with the planning, with planning the audit of the Crux group. We can add for the year ended 30th September 20x5, right? Because this is supposed to be the year end and this is supposed to be the audit which we will be doing for the first time. So we will mention the date that for the upcoming year end we are planning the audit of the Crux group for the upcoming year end. So this is how we are stating it. Now since look at this, part A tells us to evaluate the audit risks, part B tells us to design principal audit procedures on segmental information of revenue, part C tells us to discuss the matters for the social and environmental information, and part 4 tells us about the audit data analytics to enhance the audit efficiency, effectiveness and quality in the group audit. So let us summarize these points and right now the briefing notes contain an evaluation of the audit risks, the part A, right? We are going to take the answer in a logical flow. The audit risks to be considered in planning the audit, right? Since it's the planning stage we are working at, then they recommend the audit procedures. This is the part B we are summarizing, to be performed on the group's segmental revenue, right? And then it's the part C which is going to be followed. So we would say comma, there is a discussion. It says, since it tells us to discuss in part C, so there is a discussion of matters to be considered for proposed additional engagement to advise a group on its social and environmental information, right? This is part C which we have followed, and now followed by part D, that rather let's make it a new sentence, it's getting too lengthy. There is also a discussion, the last one, of how to use data analytics to enhance the audit efficiency, effectiveness, and quality. Right? See how we have summarized the requirements of part A, part B, part C, and part D. We have just written the requirements again. That's it. We have not done anything else in this case. Have a look. This is the same information we have copied from here, just to write down an introductory paragraph, nothing else. No hard and fast rule of doing anything extra or nothing, anything big. Right? Now let's begin with the first part A. Using the information in all exhibits, evaluate the audit risk to be considered in planning the group audit. Evaluation. So let's head part A with evaluation of the audit risk, right? So that the examiner knows that in part A we are telling the part A evaluation of the audit risk, and we are then discussing the audit risks that need to be considered. And you need to remember that audit risk identification 1 mark, the effect of audit risk 1 mark 2, and if in case there is a figure involved, that is materiality, then calculation of materiality 1 marks, 3 marks. If there is no materiality figure given for that audit risk, then 2 marks per audit risk, evaluation, identification, and evaluation. So you need to plan your answer accordingly for this 26 marks question. Roughly 26 divided by 3 is not possible, but 26 divided by 2 makes it 13. But approximately 10 points, 10 identifications are required roughly, because 10 multiplied by 2 is 20, and 2 identification with the materiality makes it 6 marks, 26 marks. But still, let's go ahead, let's move on. We will find out materiality for the in the question wherever it's possible. We will try to maximize our materiality marks so that it's simple calculation of materiality, which will gain us 1 mark every time. So let's focus on maximizing our marks by focusing on 3 marks audit risks more than the 2 marks one, so that we have to save time by just calculating and writing down the answer. That's it. So let's begin with the part A now. Part A. Evaluation of audit risk. Right? Let's make it bold. You need to remember that during the exam, now since it's computer based exam, you can utilize your bold feature during the exam, so that your answer appears good, it appears nice to the examiner's view, and you're able to utilize your bold features and these tools to enhance or make it easy for the examiner. So you must follow this. Now look, first thing first, that we were given this initial information here in the first page. On the first page, it told us that You are assigned to the audit of the Crux Group, which has a financial year ending 30th September and it is a listed entity. Okay, and Pegasus was appointed auditor to the group in January 2025. Today is 1st July and it's during this year that we were appointed as the auditors. So it's the first year audit, that is, it is a new audit client, right? So obviously, being a new audit client has inherent risks that the previous year balances were not, audited by our audit team. So we need to check those because we are not sure they are correct or not. Yes, and then detection risk is increasing because we are not, like, it's the first year of audit, so we don't have that any detection risk calculated over here. It's really high at the as a first audit client. So we need to give these two basic points, 2 marks, simple 2 marks. That's it. So 4 marks from this one single point of new audit client, right? So let's draft our answer for this points. It's the new audit client. Right, so let's begin drafting our answer. First thing I told you was that since it's a new audit client, we would be the opening balances were not audited by us. That is the 20x4 September 20x4 figures were not audited by us. So we don't know whether whether that information is correct or not, and we will have to obviously look at the previous year papers to confirm our understanding of the company or the group. So let's begin writing this point first. There is a risk that opening balances may not be correct, because this is a risk, inherent risk, right? Now, why these are not correct? We will mention the reason also, because the prior year figures were not audited by our company, our firm. So we will mention the name of our firm to make it more case oriented, because this is a company, right? And this is the risk identification which we have given up till now, 1 mark. But 1 more mark, why this is an issue or how we would be resolving this issue. The second mark. So what we would do is we would plan the audit. We would plan to audit the opening balances, right? We will audit the opening balances. What would that planning the opening balances do? To ensure that opening balances are free from material misstatement. That's it, right? You see how we have drafted this 2 marks point in 2.5 lines only. There is a risk that opening balances may not be correct. One thing, why? Because the prior year figures were not audited by Pegasus and company. Simple, 1 mark. What would happen, or what course of action would we take? We would plan to audit the opening balances to ensure that opening balances are free from material misstatement. That's it. So simple, so easy, right? Now, since we took out this one point of not the last year figures were not being audited by us because they are new auditors, and since it's a new audit client, obviously the new audit client has an inherent risk of high detection risk. So let us draft a point for the new audit risk, that is the detection risk, high detection risk. The group, this is, I am changing the paragraph only, no, not the heading. The heading is supposed to be the same. The group is a new audit client right? The group is a new audit client. Now what this gives rise to high detection risk, right? What happens from the group being a new audit client? This gives rise to a high detection risk, right? Why is the detection risk high? We will tell the reason for this now. Our firm has no previous or no prior experience, right, with the Crux group. You are able to follow what I am doing? I am giving the reasoning behind why a new audit client has a high detection risk. Our firm has no prior experience with the Crux group, making it difficult for us to detect to detect material misstatements, right? These are two simple points which we have made and too easy to gain 4 marks. We have just gained 4 marks from this point, new audit client. We have covered 4 marks from this simple and easy point given to us, that it's a new audit client. So 26 minus 4, 22 more marks we need to work on, right? Now let's come back to the case. Or exhibit 1 was the requirements, so let's skip this. Exhibit 2. Now see, this is just info. I have highlighted this for the 3 brands name only, and this was the policy of recognizing revenue, but we will make use of this one later ahead. Now let's scroll down. Now this one, in the financial year, the group will spend $75 million on upgrading and maintenance of the Sunseeker cruise ships. So it says $75 million that is planned to be spent on the upgrading and maintenance of the Sunseeker cruise ship. So don't you think we can draft a point for this, because we are given a figure over here, 75 million. As I told you, wherever the figures are given, you utilize those figures. We will try to make points using the figures and defining materiality and gain 1 mark for that. So this makes this audit risk a total of 3 marks, right? So how about drafting a point for this one? So we will utilize this heading upgrade and maintenance cost, right? To make it easy for the examiner to identify what we are trying to tell in this paragraph, upgrade and maintenance cost, right? Again, we will make the heading bold so that the examiner can easily identify our point and get an understanding of what to look in our paragraph, what information to look for. Okay, so since we are provided with this 75 million figure, but we don't have any other information right now, so how we will always calculate materiality based on total assets and profit before tax. So over here in this exhibit number 3, we were provided with the information of profit before tax and the total assets. So see, 75 million divided by 81 million, the profit before tax, multiplied by 100. So this gives us 92.59259259. So it's roughly 92.6%, right? The rounded figure is 92.6%. Profit before tax, material, right? 92.6%. Then 75 divided by the total assets 1800 multiplied by 100. So this is 4.1666667. So this is a round of 4.2%, of the total assets. So this is also material, right? Look how we are utilizing the figure. We found the figure 75 million and we have calculated the materiality based on the total assets and the profit before tax. Now let us draft this point, right? The group plans to incur $75 million on upgrade and maintenance of the Sunseeker cruises, right? We have mentioned this. We have taken this information from the question itself. This now we will tell the materiality. This amounts to 4.2% of the total assets, right? This figure has used the projected figures for this year because this is the planned expenditure for the current year. So based on the current year expenditure or the planned expenditure, we will be utilizing the projected total assets, projected profit before tax of the current year, not the previous year, in calculating materiality. So you need to remember this. So this amounts to 4.2% of the total assets and 92.6% of the profit before tax, right? So now we have concluded that this is material, right, to the financial statements. So let us write this down because this is also a part of the 4.28 to 92.6% calculation. This is material to the financial statements, right? We have jotted this down. We have told that this material to financial statements. We have calculated the materiality and we've gained 1 mark for this one over here up till now. Now what kind of risk appears? Audit risk. We need to define the audit risk over here. What kind of audit risk appears over here? Think of it. There could there could be an audit risk that the costs are not the upgrade costs or the maintenance costs are not distinguished properly. The upgrade costs are supposed to be capitalized to the total assets and the maintenance costs are to be expensed in the profit and loss statement as an expense. So there is an audit risk that the classification of the costs, upgrade costs and maintenance costs could be accidentally like upgrade cost could be accidentally or mistakenly expensed and the maintenance cost can be accidentally or mistakenly capitalized. This is an audit risk, right? So let us draft this one. There is an audit risk that the costs are not appropriately classified as capital expenditure, right, and operating expenditure. That is a charge to profit and loss account as an expense, right? You are able to follow? I want you to follow, please. I want you to follow. Now, what we have told the materiality, we have told the risk. Now, what would happen? Right? Let us see one. Let us try to complete this one first. The 3 marks, easy 3 marks. Now see, there is a risk. We will say that there is a risk that what risk appears if the wrong classification is going to happen. That assets are overstated or expenses are understated. Right? We've told what would happen from the miss or the incorrect treatment. There is a risk that assets are overstated or expenses are understated if the operating expenses, because this alone did not complete the treatment which we are doing, so we will complete it by if the operating expenses are inappropriately or incorrectly expensed. This treatment was for the expensing, right? We will uh, what we have done is, no, rather, see if the operating expenses are understated, if the operating expenses are capitalized, sorry, then the assets would be overstated and the expenses understated if the expenses are incorrectly capitalized due to wrong treatment, right? Right. And if you know one more thing comes in for over here, we will make a separate paragraph for that. We will gain mark for that. That is if the expenditure is wrongly capitalized. The assets are wrongly capitalized, the expenditure is wrongly capitalized, increasing the asset, and if the asset is increased, the depreciation expense would certainly increase. Don't you think so? And if the depreciation expense is increased, so obviously the expenditure in the profit and loss statement would have increased, which will result in overstatement, right, of depreciation expenses and the capital expenditure both. Both will be overstated. So let us write one line for this one also, that if the operating expenses are capitalized, are incorrectly capitalized, right? So what would happen then? The then the depreciation expenses or expense would be overstated, right? And the capital expenditure overstated too, right? See how briefly and how concisely we are drafting points. We are taking out multiple points, multiple scenarios, multiple answers from one single point which we are identifying in the question. Now let's move on. Now one thing more which we highlighted was equipment in the gyms will need to be replaced on average every 3 years. So that is a component of the cruise ship that needs to be replaced every 3 years. So the depreciation for the gym equipment would be for 3 years only, life of 3 years only. Don't you think so? There is the cruise itself, the other components of the cruise, some major, some minor, would be depreciated separately, because the standard accounting standard allows us to depreciate them separately. If their cost is recognizable, can be identified separately, the accounting standard tells us to depreciate them separately or based on their useful lives. right? So we can draft a point for this one as well, that separate identification and separate depreciation should be charged for the equipments based on their useful lives. Simple. See, as I told you, most of the sentences in the case do give us information to draft our points, draft a point for that. So let us draft another heading: component depreciation. It's the gym which we will be talking about, right? So we can say that the account, it's not necessary to mention the accounting standard name. You can directly write like I am mentioning the accounting standard, right? Requires each part of the property. We would mention this way: property, plant and equipment. We are telling the accounting treatment first. uh, with a significant cost to be depreciated separately, right? We've told the accounting treatment. Now, we've just told the accounting treatment right now. How would we further tell what risk it adheres to? What risk is coming up, or what risk is coming in between? Let me make the scrolling a bit up so that you can easily read the answer. So we would say that this accounting treatment, we would say that there is a risk that this accounting treatment is not being followed. So there is a risk that this accounting treatment is not being followed for the cruise ships, right? Because the cruise is a big ship and it has many components, it has many separate portions which can be valued down into use separate piece of paper. So there's a risk that they are not they are not following the accounting treatment and not breaking them into parts or components. So there is a risk that the accounting treatment is not being followed for the cruise ships, and they are not being broken down into separately identifiable separately identifiable components with separate cost, useful life and residual value, because all the parts might have some residual value too, right? So we have given this, we have told what is going wrong in this case and what could happen. You are able to get what I'm saying. Now we haven't told the risk based on this one. We will tell what kind of a risk could occur or what would go wrong, right? Uh, Now you tell there is a risk that if the components are not separately identified, there if there is a risk that if the components are not separately identified, their depreciation could be over or understated, because we are not sure about the useful life. If the useful life is less, then the depreciation is understated. If the useful life is more, the depreciation might be overstated, because we are not sure about the figures of under or overstated. So we are giving an open answer to the examiner that it could be both. It could be either of them, because we are not sure. We are not provided with the figures. It could be either of them. It could be either overstated or understated. Right? You're able to follow what I'm doing. You need to focus. See how we are covering up points. The next one which would follow would be sorry. From this paragraph, Explorer cruises. First, we are given the total cost of 110 million. Till here, we don't know what's to be done with the 110 million amount. Then comes the chairman of the group and the chairman of the Vela shipbuilders is the same, which is the key management personnel of the group, right? The related party transaction comes in over here, key management personnel. So we would first pick up this point, related party transaction. Then it tells us about the 110 million being financed by a bank loan and with a fixed interest rate of 6% per annum, where the borrowing cost element comes in. So we will go in a logical flow. We won't jump to the next part first. First, we will cover up the related party transaction, that is the key management personnel one point. Then we will come up with the borrowing cost in this case. So let's go to the answer document and draft our point accordingly. So it is supposed to be a related party transaction, because our chairman and the chairman of the ship company is the same, right? So we would start drafting our answer from here now. Now we will begin with the related party transaction. We will begin with the Max Draco. Max Draco, right, is the chairman for both the Crux group and the Villa shipbuilders, right? Now we have stated why this, what is the role of Max in both the companies, and now we will tell about him being the related party. How this is because of which we are saying it's a related party transaction. So you say that Max Draco is the chairman for both the Crux Group and Villa Shipbuilders. Uh, Therefore, it is a related party transaction. Right? Now, how would we define the audit risk in this case? There is an audit risk. Okay, what is the audit risk? That the necessary disclosures of a related party transaction are not being disclosed in the financial statements. Yes, the disclosure risk. There is an audit risk that the necessary disclosures are not made in the financial statements. You're getting the point. Or rather, we could rephrase it. Max Drago is the chairman for both the Crux Group and the Villa Shipbuilders Company. Therefore, it is a related party transaction. There is an audit risk that the necessary disclosures. You can say that the necessary disclosures relating to the purchases are not made in the financial statements. Now, why this is an audit risk, we'll have to tell this thing. So we would say that related party transactions are material by nature and by amount, right? Any amount is material if it is related party transaction, and the nature of this accounting standards have told that the nature of a related party transaction is also material, right? Now the next one, the $180 million we were supposed to write about the borrowing cost capitalization, right? Now let's see this one. The purchase of the ships was financed through a $110 million loan with a fixed interest rate of 6% per annum, right? So this qualifies for a borrowing cost capitalization because the amount of the loan was the same as the cost of the ships, right? So let us now draft our answer. The we would say that the ships being constructed over a period of 2 years, right, fall under the definition of a qualifying asset, right, because the amount is the same. Fall under the definition of a qualifying asset as it takes a substantial period of time to get ready for its intended use or sale, right? But in this case, it was being prepared by Vela shipbuilders, so it was the purpose of sale for that company, but the borrowing cost was being incurred by Max Draco's company, Crux Group, and in this case, we would say that uh, because of this, you would be saying that this is a qualifying asset, and this was 3 years. Sorry. Now, what is the audit risk in this case? You tell the audit risk. The audit risk is that the interest cost, right? Interest cost have not been capitalized and have been expensed out, right? Have not been capitalized, rather expensed out as finance cost, right? This is the audit risk in this case. Now, what would have happened if it was not capitalized and expensed out? The assets would be understated, and the expenses will be overstated, therefore the profits being understated, right? So we would say that resulting in understated assets and profits, the net impact, right? Profits for the year. You would say for the year, right? We need to tell the complete answer. And there's another loan being taken out of 180 million at a fixed rate of 6.5%, which was taken out to build the other three ships, right? So what we would do is that we would state about this one also, right? So over here we would say that sorry, the loan of $180 million taken out to build three ships currently under construction, because they are being constructed by the company Vela Shipbuilders, currently under construction, right? The loan of $180 million taken out to build three ships currently under construction would bear an interest cost of 180 million multiplied by 6.5 divided by 100. So it's 11.7 million, right? Of $11.7 million. Right? Now it's 11.7 million cost, right? Which is $11.7 divided by 1800. So this gives us 200. 6 point, no, 0.65% of assets, and 11.7 divided by 81 million profit before tax multiplied by 100. So this is 14.44% of profit before tax material to the financial statements. You see, in one case, based on the total assets, it's immaterial to the financial statements, but based on the profit before tax, it's material to the financial statements, which is 14.4% of the profit before tax, and therefore material to the financial statements, or rather material to the profit, right? Or we can say the material to the forecasted profit, because we are using the forecasted figure. Now let's scroll down over here. The Pioneer Cruises. The cruises are for more adventurous travelers and are growing in popularity. In order to visit certain destinations on these specialist cruises, the group has to acquire operating licenses from the local governments. The cost of license acquisition is capitalized as an intangible asset. Okay. Now see over here in this case the intangible assets note number 2 was telling us operating licenses are acquired for the pioneer cruise ships to visit certain destinations. Licenses are amortized over the specific period to which each license relates, right? But we were given a point. Uh, This one. Recent development affecting the Pioneer cruises. Last week, the governments of several countries, which form a major part of the Pioneer cruise itineraries, withdrew their operating licenses with immediate effect. The governments have stated that this is likely to be a temporary measure being put in place to limit the number of tourists visiting areas of natural beauty, but they will not confirm when the group can resume operations in these countries, right? So we just discussed that the operating licenses were impaired due to this reason, and some must have got impaired fully, some would have gone partially, but the expected value is supposed to change from 56 million, right? We were provided 56 million as a breakup of the assets of the intangible assets, but this is supposed to change then, right? So let us draft our point for the operating licenses. You need to brainstorm yourself. You need to think well. Now let us check the materiality for this license. 56 divided by 81 multiplied by 100. So this is about 69.13% to the profit before tax, and 56 divided by 1800 multiplied by 100. So it's 3.11% of the group total assets. So it is material, right? Now again we will take use of the materiality figure because we are provided with the value of intangible assets. So now what we would do is we would state that the operating licenses represent 3.1% of the group's total assets and is therefore material to the financial statements, right? Now further we were told that the amortization takes place for the licenses, and that was perfect. So what we could do is that we would state that uh, the operating licenses are being amortized, which is in line with their accounting, which is in line with the accounting treatment for the intangible assets, right? So there is no issue, we have told that. Now what could be the reason? The audit risk, right? um, an audit risk arises due to the possible impairment on some of the operating licenses where the group operates, right? Now, what is supposed to happen from this impairment, or this not noting of the impairment? So we would say that the impairment, the withdrawal of licenses is an indicator of impairment, right? And is an indicator of impairment, and the licenses may be worth zero or significantly impaired, right? And what else can we do? We would tell that the management board should conduct an impairment review right before the year end, so that the actual figures are reflected in the financial statements, in the year-end financial statements. So we can say that management should conduct an impairment review to determine the recoverable amount of the licenses, right, to recognize an impairment loss, right? Now, what would we say further? If this impairment test is not carried out, the intangible assets and the profit before tax will be overstated, right? Because the impairment loss is going to be directly going to the financial statements, thereby reducing the profits, and the assets, intangible assets itself would remain overstated. Okay, now let's see what other points can we make. We can use this exhibit 3 figures to make comparable comparisons, and after we make comparisons like from this one also, the segmented revenue, we can utilize this information also for comparison, so that we can comment on this also. Did you think of this one? Yes. Now let's see. First we would comment on, let's make a heading, revenue trends. The Sunseeker cruise is 320 million and earlier it was 288 million, right? So let's see, 320 minus 288 divided by 288, so it's giving us 11.1% increase, right? So what we would do is, rather we can do this one thing, 764 minus 670 divided by 670. First we take out the total, multiplied by 100, so it's 14%, right? So the total revenue has increased by 14%. Then we would calculate the individual increase and decreases in the revenue, and we would draft our answer accordingly. So we can say that the revenue projected, uh, the revenue is projected to increase. We just calculated 14% by 14%, right? And we would say that the segmented revenue, or the segmental revenue shows. Now what does the segmental revenue shows us? The first one is Sunseeker cruises, and we would say that 320 minus 288 divided by 288 multiplied by 100, so it's 11.11% increase, right? So you would say Sunseeker cruise revenue increases by 11.11%, right? The next one which we have is Explorer cruises. So what has happened? 180 minus 190 divided by 190 multiplied by 100, so this becomes 5.26% decrease in revenue. So we would say the Explorer cruise revenue decreases by 5.26%. 5.26%. We would not use any minus or plus sign in this case. And then we have the Pioneer cruises, and this is supposed to be 264 minus 192 divided by 192 multiplied by 100. So it's 37.5% increase in revenue for the Pioneer cruises. So Pioneer cruise revenue increases by 37.5%, right? This we have just calculated right now. Now what would we do? See, the licenses were amortized, the licenses were cancelled by the governments, they were withdrawn by the governments, and due to which this projected increase in revenue would fall, because once our licenses are cancelled, we cannot, our ships cannot travel to those locations where they used to go earlier, and due to which we were forecasting an increase in revenue, right? So what we would do, we would comment on this, that the projected revenue for the Pioneer cruise, right, will be impacted due to the withdrawal of licenses, or due to the withdrawal of operating licenses, operating licenses by some countries, thereby impacting the booked itineraries, right? So we could say that there is a risk that segmented and for revenue is overstated, right? Now similarly we are given the profit trends. That is 81 minus 65 divided by 81 and multiplied by 100. So this gives us an answer of 19.75. Rather, this was the profit before tax we calculated. We would say the operating profit, right? Uh, 145 minus 101 divided by 101 multiplied by 100. So this is a 43.56% increase in the profit. So roughly 43.6%, right? Increase in the profit before tax in the operating profit, and thereby it will increase the profit before tax, which is supposed to increase by 81 minus 65 divided by 65 multiplied by 100. So this is supposed to be increasing by 24.6% in this current year, and the revenue was increasing by 14% only. So we can say that the profit trend, right? We're looking at how we are exploring the question. Each line is important. We're exploring the question, we are making points, and we are picking up points, and we are drafting our answer. So we can say that the operating, we just calculated, okay, operating profit. I'm noting them down on the rough paper. You will also need to note down these points or these calculations while you are doing the exam, and it does not require you to show the calculations separately. You can do it on the calculator like I did right now, and directly write down the increase or decrease, and the examiner will have no issues with that. The examiner will mark them right if they're right? So the operating profit is, since you're using the projected figures, projected to increase by 43.6%, right? We just calculated this right now, and the profit before tax is projected to increase by, this was 24.6%, right? Sorry, this was increased by 24.6%, right? Now what is the issue which we or which we could be facing based on this figure? That the revenue uh, the total revenue is projected to increase by, we are not using the segmented information over here, 14% during the year, right? When the revenue is increasing at a lower rate or at a lower percentage in terms of increase, how is the profit increasing so much? So we need to comment on this one also now, right? So we just mentioned that the total revenue is projected to increase by 14% during the year. Now what would we do? We could state that the next what we would do is we will state the increase in profits the increase in profits appears out of line out of line with the increase in revenue, right? We would state it this way. Why? Because this would be understating the expenses and overstating the profits, or other way around. So with the increase in revenue, which could be due to misclassification of expenses or understatement of expenses, right? See how we are brainstorming ourselves. We're just writing down the points and we're drafting out more and more points. Now, one more thing which we can draft over here is this: the 15% revenue from the foods onboard sales of food, drink, and entertainment. Right. So what can we do? We would say onboard sales now. We would comment on this one as well. The onboard sales amounts to 15% of the revenue. Right. Now, this being 15% makes it uh, applicable to be reported separately, because anything above 10% should be separately reported. So we would say that uh, the onboard sales amounts to 15% of the revenue, right? And we would say there is a risk that the reporting segments are not being reported. There is a risk uh, that this is a reportable operating segment, because operating is being used over here in the question again and again. So we would say operating segment, and the operating segment and the information provided does not disclose this revenue separately, this revenue stream separately, right? Candidates, this is a long question with so many points coming in. Now we would tell the examiner that we know the treatment for this 15%, that is if a reportable segment, it becomes a reportable segment once it has crossed 10% of the revenue. So we would tell we would share our knowledge with the examiner. We would tell the correct thing to the examiner why we are making such a point. So we would say a reportable segment exists when the segment's revenue is 10% or more, right? Or more of the combined revenue, right? We have disclosed what treatment should have been, or what is the information or knowledge behind our comment, and what risk do you think comes in incomplete disclosures? Exactly, you're right, absolutely right. So we would say there is a risk of incomplete disclosures, because this disclosure is missing, right? Incomplete disclosures uh, of the onboard sales, right, in the financial statements. Think simple, be simple, and pass this paper. Now, like I told you earlier, let's scroll upwards towards the top of the question and the initial lines. Not here exactly. Let's scroll downwards now. This is, let's come to exhibit 2. Yes, here 2 weeks and 6 weeks. You know, we need. We discussed earlier that we were supposed to make a comment on this one as well in our answer. Don't you think so? Yes, the revenue recognition criteria is not being met because this revenue is being recorded as soon as the ships are boarded, whereas revenue should be recognized over a period of time in this case. So we can say that revenue recognition, right? Now let us draft our answer for this revenue recognition. 2 lines only, not more than 2 lines. Uh, an audit risk uh, arises in relation to the timing of revenue cutoff or revenue recognition, right? Uh, Now, why this is an issue, we are going to briefly tell that it is appropriate. We are telling that it is appropriate to defer the customer deposits, right? Made to defer the customer deposits made before or made at the time of booking and onwards, right, for the next partial payment. Now, what is the issue here? We need to tell this issue also. So we would say that an audit risk arises in relation to the timing of revenue recognition. It is appropriate to defer the customer deposits made at the time of booking and onwards. Right, so that's it, right? Now, what else? One more point I am coming across in this one was the cyber attack, remember? In the notes. Cyber attack. Last month, the group suffered a cyber security attack in which the personal customer information of 1,400 customers, including their credit card details, were stolen. According to the representative of the group audit committee, the group's internal audit team had not properly assessed the risk relating to cyber control, which is a requirement of recently introduced data protection legislation in the jurisdiction in which the group operates. The issue which led to the cybersecurity attack has now been resolved. Right? Rather, wait, this I feel like revenue recognition we can comment further about 2 weeks and 6 weeks because I'm not comfortable with this explanation yet. So we would say the policy of recognizing all revenue uh, from the ticket sales, right? When the cruise begins, right? The policy of recognizing all revenue from the ticket sale when the cruise begins may not be correct, since the group is performing its obligations over time. Obligations over a time and what we call it over a time period of 2 to 6 weeks, right? Uh, the problem of cutoff comes in making the revenue overstated and thereby the profits overstated. The profits overstated, right? You're getting my point. Just clicked my mind that we have missed something over here. Now the next thing which you were planning was cyber security attack, right? So what is your mind now of the cyber security attack? The first thing which I highlighted was that there are weak internal controls while we were discussing the question, that there are weak internal controls due to which the internal audit team had not assessed this issue properly, right? So we can say that let us draft this one. Cyber security attack could be highlighted or could be due to weak internal controls at the Crux group, right? Now we would say that this issue was resolved, right? So we can say that although the issue was resolved, right? What else? The group internal audit team could be facing deficiencies in internal control Oh, alright. Now let us see what else can we think of. There could be corrupted data or loss of data, right, because of the cyber security attack. One more thing, just clicked my mind. So we can say in another paragraph, we would say that the cyber attack could have resulted in corrupted data or loss of data, right? Relating to revenue, right? Relating to, because revenue is the main stream of income which highlights or which carries on the remaining part of the financial statement. Loss of data relating to the revenue, right? This is another aspect which you have just covered. What audit risk could occur? There is an audit risk that the revenue figures are incorrect, right? One more point which we just highlighted. And what else can we think of from cyber security attack? Loss of information of 1400 customers would have resulted in fines or penalties by the government to the company for not having efficient controls. So we can say that the cyber attack and the loss of information could result in penalties by the government bodies, right? Because there could be various government bodies being involved. And what else we could the disclosure of such penalties, or rather we could say that what we call contingent liability, right? So the disclosure of such penalties shall be made in the financial statements, right? The audit risk could be, because we are just figuring out it by ourselves, could be understated liabilities, expenses, and overstated revenue. Right, in the financial statements. You see how we have drafted so many points just from one part of the part A of the exam question. So look at this, it's page 3 up till now. 3 pages we have just made for one answer, so part A. But you need to focus on how many points we have covered. There are more than 26 marks we are getting in this question, right? So that's it for now. In the next video we will continue with part B of the question that requires us to make procedures. Let us come to part B. Design the principal audit procedures to be performed on the segmental information relating to the group's revenue. Alright, so the group revenue which you are provided with, we need to provide audit procedures for that group or revenue figures, the segmental figures. Right, so let us keep it now here till now, and we will continue in part B in the next video. Alright, thank you. Towards the end of this video, you need to remember greatness doesn't happen overnight. It's the result of continuous effort, boundless curiosity, and a thirst for improvement. Investing time in these videos and engaging with past AAA exam questions is an investment in the brighter future you're shaping up. Keep your focus sharp, your learning continuous, and your eyes focused on your goals. Best of luck as you navigate your studies. May your dedication lead you to success in the AAA exam.